Please come on in. There's room for you if you'd like. It's a great pleasure to welcome all of you to the George S. Eccles Memorial Lecture in Economics and Finance. This lecture was established by George Eccles, after whom this business building is named, in 1973. George grew up in Logan, was born here in Logan, attended Utah State, finished at Columbia, and with his brother Mariner S. Eccles, the famous chairman of the Federal Reserve under the presidency of Franklin Delano Roosevelt, established the bank that became First Security Bank, which in 1999, 2000, something like that, merged with Wells Fargo. George was a fierce advocate of economic literacy. Felt really strongly that that every citizen needed to know something about the way the economy worked, and so established this lecture in order to help foster economic literacy here in his home state of Utah. We have had over the years some very, very distinguished individuals who have been George S. Eccles Memorial Lecture distinguished visitors. Among them, including Milton Friedman, Alan Greenspan, and last year, the Nobel Prize-winning economist Ed Prescott. Today, we're particularly delighted to welcome James Bullard, who is president of the St. Louis Fed and has participated in the Federal Open Market Committee, is one of the most important voices in the Federal Reserve today, and I think he would like to refer to himself as a voice of reason. We would certainly agree with that. He has his PhD from Indiana University. He's from Minnesota originally, where he got his undergraduate degrees at St. Cloud University. I hope you'll find this session to be as fascinating, as interesting as the informal luncheon discussion that we had. Now, just a word about the structure of the lecture and how we're going to proceed. Dr. Bullard has prepared some prepared remarks, which he will give until something around a quarter after the hour, and then we'll have about 15 minutes for an open Q&A. And then we have invited the members of the press who are with us today to have a separate session with him in a conference room just outside of this room and in the lobby. And so that we might facilitate his ability to move quickly from here to over there, I'm going to ask the audience to stay seated until he's able to leave the auditorium with the press. Now, I realize some of you have classes at 2:30, so we're going to try to wrap up just a minute or two before you'd have to leave. But if you don't have a class, please don't leave so that we can facilitate this transference of space. With that, I hope you'll join me now in welcoming Dr. James Bullard.
Well, thanks so much, and thanks for having me here to give this memorial lecture. It's certainly a pleasure to talk at the same lecture that Ed Prescott gave, and I'm actually going to refer to Ed's work here a little bit. So if you're keeping your eyes open, you'll see him on one of the slides. Certainly a great tradition. A lot going on here at Utah State. It's very interesting to see everything and all your smiling faces out here. Really anxious to learn some macroeconomics. This is going to be a kind of a mix between, I'd say, a newspaper level discussion and a classroom discussion. So there are some equations in here, not a lot. But if you're not familiar, don't worry about it. I'll try to walk you through what I'm trying to talk about here. So I titled this Hawks, Doves, Bubbles, and Inflation Targets. So I hope that's getting you interested. See, in the macroeconomics world, this is about as exciting as it gets. You know, so Let's see what we've got here. Some of you know that the Federal Open Market Committee, of which I'm one member, the January 2012 meeting. There's been some discussion since then that this type of inflation targeting is inconsistent with the Fed's dual mandate. And so the purpose of this talk is to try to walk you through some of the arguments I think are common in the macro an inflation target. You can still be a hawk if you want. You can still be a dove if you want. And in fact, you can still get bubbles and more. So there's lots of things that are consistent with in this talk is that the issue of inflation targeting is sort of separate from many other issues that are surrounding monetary policy. So let's see if I can convince you or make any progress on that. Now, so the Open Market Committee named an explicit numerical inflation target of 2%. It is based on headline inflation. I'm not going to talk about that issue here today. So I'm not going to talk about a lot of issues here today. So if there's some things you want to ask me during the Q&A that don't come up during the talk, please feel free to do so. But it is with respect to headline inflation over the medium run. So we understand that there's going to be shocks that hit the economy, change the inflation rate from time to time. And, but still, I think it is important for the central bank to say what it's going to do with respect to inflation, since it's really the central bank in a fiat currency system that has responsibility for the long-run rate of inflation. In other contexts, I've argued that inflation targeting is the modern substitute for the gold standard, because you'd like to nail down, you'd like to get the central bank to nail down what is it that you're trying to do, show me that you're doing what you're trying to do, get some responsibility on the central bank. So we've joined many central banks around the world in adopting an inflation target. It's been Chairman Bernanke's goal since joining the Fed. Shows you how long it can take to get things done, because it's been a while since he joined the Fed. Congratulations to the chairman on getting this done. Now, the dual mandate is in the legislation that found the Federal Reserve Act. Was amended in 1977, and the dual mandate is actually a triple mandate. So there you go, you learned something today. It's a triple mandate, and the triple mandate is that the Fed should conduct monetary policy to promote effectively the goals of maximum employment, stable prices, and moderate long-run interest rates. We're nailing that third one, the moderate long-term. Just nailing it. No one gives us any credit for that one. So most just focus on the two goals, maximum employment and stable prices, hence the dual mandate instead of the triple mandate. Now, the ECB, that's the European Central Bank, for those of you that don't follow these matters. So the European economy is roughly the same size as the US economy, maybe a little bit bigger. So the ECB, among world institutions, is sort of the comparable institution to the Federal Reserve. They have a single mandate. Their single mandate is stable prices. That mandate is often thought to have been heavily influenced by the Germans, who, in order to set up the ECB, had to acquiesce to setting it up, and they set it up in the mold of the Bundesbank, the German central bank. And so they said that the goal would be stable prices. Some of you that know your history, take this down. Germany was ravaged by hyperinflation in the 1920s, and that memory is still very strong in Germany, so they're very worried about letting inflation get out of control. However, in practice, even though the ECB has a single mandate and we have the dual mandate, in practice, monetary policy is viewed the same way in Europe as it is in the US, despite those differing mandates. So hopefully I can shed some light on why that might be true. And here's just a picture to maybe just talk about that for just a minute. Here, this goes back to January 2007. These are policy rates in the two areas, U.S. and the Euro area. Also on here, Japan and the U.K. But let's just look at Europe and the U.S. So the recession hits globally really in the fall of 2008 and the first part of 2009. All the central banks around the world lower interest rates. So everybody reacts the same way. So you might say, just based on this picture, this is kind of flimsy, it's just kind of flimsy evidence. But at least, based on something like this, the central banks don't really behave very differently. When recession comes, they lower interest rates. When times are better, they raise interest rates, and they don't behave that much differently, even if they have different mandates. So let's see if I can sort of get across why that might be. So in this talk, I'm going to use a simple toy model. It's toy by macroeconomic standards because it's only 3 equations. May not seem like such a toy to you, or at least not the toys that you're familiar with, but that's okay. We'll just I do want to put up some equations just to talk through a little bit some of the considerations. And then we're going to look at a simple monetary policy rule. It's a Taylor type policy rule, and I'll talk about that a little bit. Some of you may have heard of the Taylor rule, invented by John Taylor at Stanford University. He really likes it because he can put all the recommendations on the back of a card, on the back of his business card that come out of the Taylor rule, so it's very compact that way. And then if you add this simple toy model together with the policy rule, you'll get an equilibrium, and that's what we really care about. So the equilibrium will be output will go move around over time, and inflation will move around over time, and that'll be the equilibrium because that'll be the situation where supply equals demand all the time in the economy. And then in the policy rule, there's going to be parameters which describe how aggressively the central bank reacts to inflation and how aggressively the central bank reacts to the output gap or the real side of the economy. And so there's kind of 2 parts to the policy rule, and that will affect how the economy evolves over time, what those choices of those parameters are. So the key point about this whole discussion is that the choice of the inflation target is really a separate debate from the debate over how much should I respond to inflation and how much should I respond to output or other real variables in the policy rule. So those are 2 separate debates. That's the only point I want to get across, and I'll see if I can do that in this talk. So let's talk about this toy model. We'll get to work here. Roll up your sleeves. If you're not interested, check your BlackBerry. Here's how models work. And I just have one slide on this for those of you that aren't familiar with macroeconomics. You start off with households. Households are going to maximize an index of material well-being. It's a theory of material well-being. It doesn't address all kinds of other things. It's just talking about, from the household's perspective, how much do I get to consume and how much do I have to work? My goal is to be one of the idle rich. I don't want to work at all. I want to consume a lot. Okay, but that is impossible. I'm going to have to work in order to get income, and I'm going to use that income to consume. I also like my leisure time, so I'm going to try to balance all these things off. So households are going to maximize this index of material well-being by making decisions on how much to consume, how much to save, how much time to devote to market work. So the households care about the future as well. They care about how much of their current income they're going to carry into the future. They want to make that decision as optimally as they can. So this is basically, and I'm skipping a lot here, but basically that's going to give you one equation in the toy model, this household decision. The firms are simple objects as well. The firms just hire workers, and they ask the workers to help produce some output, and they go sell the output back to the households. And the firms are going to face this sticky price assumption, which I'm going to talk about in just a minute. They make this decision, the firms make the decision, what price should I set for my output? They also make decisions about how much labor to hire and so on. I'm not going to talk too much about that. That's going to give a second equation in the toy model. The third equation is that the monetary authority controls the short-term nominal interest rate. We're going to use this Taylor type policy rule, which is described by John Taylor. Just to talk about it and talk about what kinds of things come up, and then we won't see any more equations after that. Now, there is a controversial assumption here, which is the sticky price assumption, and I want to be clear about what this assumption is. By the way, this kind of work has been popularized by Michael Woodford, so for those of you that are students of economics here, I would recommend Woodford's book, Interest and Prices. It is a tour de force. Woodford is surely a future Nobel Prize winner. He's done tremendous work on this issue. Whether you agree with him or not, he's done a great amount of work, he and his students. Now, the key assumption is that prices are sticky in a certain sense. So when the firms are making their pricing decision, they can only change their prices every so often. So well, when they can change their prices, they can set it to whatever they want. So if prices are perfectly flexible, then you get back to the kind of stuff your previous lecturer here talked about, which is Ed Prescott. So Prescott has a model, prices are perfectly flexible. There is no sticky price assumption. If prices are perfectly flexible, they're moving all the time to equate supply and demand in all the markets all the time. And there's shocks hitting the economy, but the prices are moving around to equilibrate markets all the time. So there's no role for monetary policy in that world. There's no role for monetary policy in that world. So if you get back to the flexible price model, all this goes out the window. Okay, so the sticky price assumption is actually quite controversial within macroeconomics. You can see the Bills and Cleanout paper if you're interested. And you might just reflect in your own life, how sticky are prices really? You go to the car lot, they seem pretty flexible. You go buy a house, they might seem pretty flexible. You go buy toothpaste, kind of seems like the price is the same week after week. So it's kind of a tough question as to how sticky prices are. But I'm not going to challenge the sticky price assumption here. I just want to make you aware that if the sticky price assumption goes away, you go to the Prescott world, there is no role for monetary policy in that world. Okay. So here's our three equation system. These are simple equations. Z, let's just start with the left-hand side. Z is the output gap. Pi is inflation. It's actually the deviation of inflation from the target rate of inflation. And R is the deviation of the nominal interest rate from its long-run value. So these are all in deviations terms. So when these equations are in so-called steady state, the left-hand side variables will all be zero because all the values will have come back to their sort of normal value or long-run value. This epsilon over here is the driver of the business cycle. So there's shocks coming into your world and they're knocking you away from the steady state at every point in time. The model's forward-looking. So all modern macroeconomic models are forward-looking because, why? The actors in the model are forward-looking. The households are looking out over the future. They see their future. They're wondering what the wages are going to be in the future, what the prices are going to be in the future. Based on what they see out there in the future, they make decisions today. So this shows up in these terms here. Expected future output gap, ET, ZT plus 1. ET means expectation. So this is the expectation today of the output gap in the future. This is the expectation of the inflation rate in the future. Here's expectation of the inflation rate in the future again. Here's Z's and Pi's in these equations here. Again, you've got this driving shock over here. Shocks are coming into the economy. That's driving the business cycle. There's some parameters in here which I'm not going to talk about too much that come from this kappa, the beta, and the theta. These parameters come from the details of the structure of the model. I'm not going to worry about that too much, but I will mention You just look at this equation here, the second equation, so-called New Keynesian Phillips curve, huge literature on it. Today's inflation rate depends on today's output gap and depends on expected inflation. But I'll just let you know from Woodford's original work, this number is like a 0.99, and this number in the calibrated case is like a 0.024. So think of this. So what this is really saying is inflation today is expected inflation tomorrow. That's why expectations are so important in the world of central banking. So the feedback from the output gap to inflation, 0.24, really small number according to this simple theory here. Now this thing down here doesn't come from any optimization problem. This comes from John Taylor's head. So John Taylor said, okay, we'll set the nominal interest rate as a function of inflation today and the output gap today with these parameters, which I'm going to call phi z and phi pi. So these parameters say how much do I want to react to, not inflation, but the deviation of inflation from target and the output gap. Okay? And that will determine how much I change the nominal interest rate with respect to the long-run value of the nominal interest rate. So that's our three-equation system. I'm not going to show you these three equations anymore, but I do think it's interesting just to point out to an audience like this, the expectations are going to be important. Expectations of the future are going to be important. If you keep those of you that know a little bit of math, if you kept substituting in for the expected value, kept substituting the equation back in, you would get a whole future sequence of expected z's and expected pi's. So it's the households and the firms care not just about tomorrow, they care about the whole infinite future and what that looks like. But it's still a toy model in the end. I'm going to spend a long time at the end of the talk telling you about all kinds of things that aren't in this model. Okay. What is the output gap? The output gap is not the output gap that people usually talk about. Usually people have the idea, they take some trend measure of output, and wherever we are relative to that trend, that we call that the output gap. That's not the right output gap from the perspective of this model and from the perspective of modern macroeconomics. Instead, the output gap is the difference between the amount of output that would be produced in the flexible price world, the world where the central bank wouldn't have any role, and the amount of output produced in the sticky price world. So there'd be some difference, which is due to the sticky price assumption, and it's only that amount that the central bank can do something about. So the other thing about the flexible price level of output is shocks would still be hitting the economy, and prices would be adjusting all the time, even in the flexible price world. So the flexible prices are moving around all the time. The sticky prices aren't moving around quite as much as the flexible prices, and for that reason, you've got some kind of gap between the sticky price level of output and the flexible price level of output. That output gap is completely different from what's talked about in the typical discussion, typical policy discussion. But I'm working on them. And so I might get them to come around sooner or later. If you did the output gap this way, you'd get, it'd be a lot smaller typically than conventional measures once prices have a chance to adjust. How long has it been since Lehman AIG? More than 3.5 years. Do you think that's enough time for prices to adjust? I think it might be. That's a long time. Most sticky prices, you're talking about quarters or possibly a year at the outside. You're not talking about 3.5 years of sticky prices. All right, where's the inflation target in all this? You probably forgot. You forgot now that I'm talking about inflation targeting. So the inflation target is not actually in those numbers. That's because it's inside the pi t term. The pi t was not inflation. It's the deviation of inflation from the inflation target. So since the central bank controls the inflation rate in the medium and the long term, the inflation target is simply an embodiment of this fact. So in effect, what researchers are doing is they're penciling in the long-run rate of inflation they think the central bank desires. So they're thinking of pi t as being the actual inflation rate today minus something like pi star, whatever the pi star being whatever the central bank wants to get out of inflation. They're penciling in the long-run rate of inflation. So historically, central banks did not say very much about what rate of inflation they were trying to achieve in the medium run or the long run. Some of you don't know your macroeconomic history, but let me tell you, there was a global inflation debacle in the 1970s. We had 4 recessions in 13 years. We had double-digit inflation. It was the #1 political issue, and it wasn't until Paul Volcker became chairman of the Federal Reserve that we started to get that situation under control, and it took a long time to get it fully under control. So, I think you have to be very wary about letting the inflation genie out of the bottle. The notion of the 1970s was, if that process gets started, it is very hard to control. Now, since the central bank does control the inflation rate, there seems to be little to be gained from hiding the inflation target. What would be the purpose of keeping it a secret? That if you keep it a secret, financial markets will still look at the central bank. They will still pencil in what they think the central bank is going to do. That is, they'll pencil in their own perception of the inflation target in any event, but they'll have some uncertainty about what the central bank is really trying to do. And that just adds unnecessary uncertainty to the macroeconomic system. So there seems to be no purpose to hiding the inflation target. You might as well put it out there and say what you're trying to do. Now, is that a hawkish thing to do, or is that a dovish thing to do? I think that naming an explicit numerical inflation target is neither hawkish nor dovish. It's simply a recognition that the central bank controls the medium to long run rate of inflation, and that in order to minimize uncertainty, the central bank may as well say what it is trying to achieve. Now you might say, why 2% as opposed to 1% or 3% or some other number? That is actually itself the subject of a large literature in macroeconomics. The literature generally comes down on the side of a very low rate of inflation, and as a practical matter, many central banks have adopted 2%. So I'm not going to go into this debate, which is a lengthy one, but it generally does support low rates of inflation. Now, the original question was, so you adopted an inflation target. Is this consistent with the dual mandate? Is adopting an inflation target consistent with the dual mandate? And I'm going to argue that it is. So think about the steady state of this system that I wrote up earlier. That is, inflation's at target, output's at potential, and the nominal interest rate is at its long-run value. In that steady state, the central bank is indeed achieving its inflation target, but the other equations representing what's going on in the private sector, markets are clearing out there in the private sector, they churn out the steady state values of the other variables. The central bank doesn't control how much time households want to devote to the workplace, how much households want to consume, how much firms want to produce. All those things are decided out in the private sector. But these equations determine the steady state level of consumption and the steady state level of labor supply in particular. And the steady state level of labor supply could be interpreted as the maximum employment of the dual mandate, because it is the amount of time that the households desire to work given the wages and all other variables that are out there in the economy. So they look at that situation and they say, well, given all that, I want to work this amount. In the steady state, they actually get to work that amount. So you still got the shock coming in. The shock is knocking you off this situation all the time, but either above or below. But in the steady state, you'd be achieving the maximum employment part of a dual mandate. Now, the best policy actually achieves the dual mandate exactly. So if there's some engineering types in here, you would have noticed immediately that you have one thing that you can move, which is the nominal interest rate, and you have one shock. You can actually move the nominal interest rate to completely offset the shocks that are coming in. So it's like Star Wars, you know, when the guy's shooting at him and he uses the lightsaber to knock everything off. It's just like that. So the shock keeps coming in, choo, choo, choo. So when that happens, the nominal interest rate moves around to offset the shock that's coming in. All the other variables stay right at the steady state value. So inflation stays right at the target rate of inflation. Consumption stays right at the steady state level of consumption. And in particular, labor supply or employment remains right at the steady state level of employment. So it remains at the maximum level. So actually, in this toy model, you can achieve the dual mandate perfectly at every point in time. You can achieve it perfectly at every point in time because you just offset the shock perfectly. You get employment at target, and you also get employment at the maximum level. So I think this is very helpful to get in our heads what's going on in these models. I understand, and you understand too, real world policy is not going to be able to fully offset shocks that come in. For one thing, it's hard to know what all the shocks even are, but provides a conceptual benchmark for what we're talking about here. So the main point is that a good policy could achieve the dual mandate at every point in time. Now, suppose we switch to a single mandate. You go to what the ECB has. The ECB just says, I'm just going to have stable prices. They don't have a dual mandate. Oh, but wait a minute. Think about how this model works. In a single price stability mandate system, the essential story doesn't change at all. The central bank still controls inflation over the medium term. It still makes sense to explicitly name the inflation target as opposed to hiding or keeping it secret. Why would you keep it secret? That's just going to induce uncertainty in the system. And achieving the single mandate, which is keep inflation at target, you know, the way I just illustrated in the last slide, is still consistent with the maximum level of employment of households. So the single mandate might be a clearer way to describe the essential story, but it doesn't really change the story. So this is my thinking on why ECB has a single mandate, US has a dual mandate, but when you look at the behavior, it doesn't look all that different. Because if you think about how this model works, central bank's still trying to offset the shocks. If they could offset them perfectly, they'd achieve the dual mandate perfectly. They'd also achieve the single mandate perfectly. So it wouldn't make any difference whether there was a single mandate or a dual mandate. Well, that's my main point. So it goes downhill from here. So now, if inflation targeting is consistent with the dual mandate, why is there all this discussion? And the answer is there's more aspects to policy than just the target. And if you remember when I was talking earlier about that model, there's those pesky policy parameters, phi pi and phi z, in the Taylor type policy rule. These parameters describe how aggressively the central bank reacts to inflation. That's the phi pi. In the macro world, pi is always the inflation. I don't know why. Phi pi. And to the output gap, phi z, is how aggressively you're going to react to the output gap when setting the nominal interest rate in the Taylor type rule. So you could think of relatively large values of the phi pi as being, on the more hawkish end of the spectrum, and relatively large values of phi z might be viewed as more dovish. So when you're setting nominal interest rates, are you going to pay more attention to inflation and inflation expectations and worry more about that, change your nominal interest rate in reaction to that? Or are you going to worry more about the so-called output gap measure and react more toward that? But I guess the main point here is that it doesn't really matter what values you choose for that. All of this is in the context of inflation and inflation targets. So whether you chose to be on the more hawkish end or the more dovish end, according to this taxonomy, you would still have an inflation target. So the main point here, I guess, is that the nature of the policy rule is a separate issue from the issue of naming an inflation target. So I think most of the discussion about the dual mandate is really a discussion about how much emphasis should be put on each of the two parts of the Taylor-type policy rule. Again, if you get back to this world where shocks could be offset completely each period, then policymakers should choose values to accomplish that. That would be a very nice world indeed, because we'd all have exactly the same consumption quarter after quarter after quarter, and inflation would be exactly the same quarter after quarter after quarter, and there wouldn't be all this fluctuation in the economy, so you'd have completely stabilized the business cycle. But that's only in the sort of this fantasy toy model. In reality, both output and inflation are going to deviate from their steady state values. So how should we set these policy parameters? Well, there's an advantage to the way I started this talk. I started this talk by saying households want to maximize this index of well-being. So I shouldn't come in as a policymaker saying, here's what I want to do. Or I shouldn't come in as a politician and say, here's what my constituents want to do. I should come in and say, I want whatever's best for these households that are the building block of my model. So if you start the analysis with households, then you can choose policy to maximize the well-being of the households. So this is superior to allowing policymakers to impose their own judgments on the macroeconomy. And in a lot of analysis that you'll see, people won't do this step. They won't go back to the households and ask them, well, what do you want me to set the parameters to? Instead, they'll just set their parameters the way they like to set them. So you would choose phi pi and phi z to maximize household utility when the system is simulated over a long period of time. I'm going to drop this here. There's a large literature on this, and there's plenty of ammunition, whether you're on the hawkish side of the spectrum or the dovish side of the spectrum. And there's a large literature, and in general, the answer is going to depend on lots of additional assumptions. So I'd need many more lectures. You're going to have to invite me out, for the next 6 months to cover that whole literature. And I know you really don't want to do that. Now, let me just talk for a little bit. This section is called Beyond Interest Rate Adjustment. So let me talk for a few minutes to close up here on lots of other considerations that aren't really part of this model. And I guess the main consideration here is that now might not be the best time to focus on exactly what that interest rate adjustment rule should be for lots of reasons that I'm going to specify here. So let's see if I can get that across. There are many more important considerations other than the nature of interest rate adjustment. That is the idea of how hawkish or how dovish the interest rate rule should be. Some of these can be discussed within the toy model, and a lot of them are just missing completely from the toy model because they're not included in there. So let's talk about bubbles. There's been a lot of discussion concerning the possibility that current Fed policy may lead to bubbles in the economy. My good friend Tom Honig, who recently retired as president of the Federal Reserve Bank of Kansas City, spent a whole year admonishing the FOMC that its low interest rate policy might lead to bubbles in the economy and might lead to more trouble down the line, more problems down the line than whatever we were solving with the low interest rate policy. I'm going to interpret bubbles to mean that there's multiple equilibria, so that would be situations where two or more sets of prices and expectations will clear the markets. You got one set of prices and expectations over here, that produces one equilibrium, but you got another set of prices and expectations over here, that also clears markets. So it's not clear the model, in that situation, the model doesn't tell you what's going to happen. Some of those equilibria we know can be extremely volatile in the theoretical models. So it's interesting that the toy model can tell you when you're at risk of multiple equilibria. The toy model can tell you when you're at risk of multiple equilibria. And the time when you're at risk is the so-called Taylor principle. The Taylor principle has to be obeyed, otherwise the model will have the potential for multiple equilibria. So the Taylor principle in its simplest form is that nominal interest rates should adjust more than 1-for-1 with deviations of inflation from target. So inflation goes up a little bit, you should move nominal interest rates up more than that amount. And if inflation goes down relative to target a little bit, you should move the nominal interest rate down more than that. So the problem of multiple equilibria occurs when these values are too small. That is, central bank sitting around on its hands, twiddling its thumbs, not doing anything. And when that's the case, you're not reacting enough to inflation, then you can get into trouble, and there's actually multiple equilibria in the economy, and some of these, this is a technical term, very unpleasant. Some of these equilibria can be very unpleasant because they can be very volatile, and maybe some of them would look like the recent crisis that we had. In fact, what's the actual worst policy, or one of the worst policies? The worst policy, in my mind anyway, is actually to set these coefficients to 0 completely. So if you do that, that means that the central bank is not reacting at all to anything that's going on in the economy, not reacting at all. What that will do in this model is guarantee that the Taylor principle is violated and guarantee that multiple equilibria exist. If you read textbooks, this is known as the interest rate peg policy, because interest rates don't change. Shocks are coming in, all kinds of things are happening. Never change anything. And go on vacation. That actually might be good. I get to go on vacation, and then we don't change interest rates, but it would be bad for the economy. Now, you might ask yourself, I'm being provocative here, actual policy rates in the US have been near 0 since December of 2008, more than 3 years ago. They're projected to remain there until late 2014, according to recent FOMC. This is a long time of not moving the nominal interest rate at all. You might think of this as an approximation to the interest rate peg policy, and thus conducive to multiple equilibria. So I would see this as a vindication of things Tom Honig has long advocated concerning the possibility that the low interest rate policy could lead to bubbles or multiple equilibria. All right, let me go through just a few more items and we'll get to the Q&A, so sharpen up your pencils if you've got some questions you want to ask. We'll get to it here in just a minute. You might say, one of your questions might be, what about unemployment? The baseline model doesn't have any unemployment. It does have labor supply of the households, and so households do get to make a decision about how much they want to work versus how much time they want to spend in leisure, but it doesn't really have unemployment the way we think about it in the real world. There's a good reason why it doesn't have unemployment in it. If you go look at the literature on unemployment, you end up going to the so-called search theoretic literature. So in the search theoretic literature, I go looking for a job, I get a job offer, and then I scratch my head and I say, should I accept this job offer or should I continue to search? If I continue to search, I might get an even better job offer, but if I take this job, then I'll have to stick with this job for a while, and so therefore I might choose to continue to search. If I choose to continue to search, I'm going to be classified as unemployed because I'm still looking for a job. So that's a pretty sticky thing because it doesn't fit with normal supply demand. It's a different concept about how to think about some of the processes that are going on in the economy. These guys, Diamond, Mortensen, Pissarides, got the Nobel Prize for this. Not this past year, but the year before. It is possible to merge the search theoretic ideas with sort of supply-demand macroeconomics. Here's a paper that does that. So this is what I have to say about unemployment. There's a reason why we don't do it this way. It's kind of hard to do it. That's why. But it can be done. It complicates things a lot. Another issue here, and the question might be in your head, is that most monetary policy today isn't about interest rate adjustment. As we were just saying, interest rates have been pretty much fixed for the last 3 or more years. Most of monetary policy today is about unconventional policy or quantitative easing. If you want to see an assessment of the effectiveness of quantitative easing, we had a whole conference on it June 30th, 2011. All the papers are on the web page. general tenor of the papers is that unconventional policy is pretty successful. But this is a long ways from the interest rate kind of rules that we were looking at before. There are other factors that are missing that were especially important during the last 5 years. One critically important area is housing, real estate more generally, not part of the basic story. Another critically important area is financial market stability. So unless you have these things in your model in a well-understood way, you see how it really works, it's not so clear you can recommend good monetary policy unless you have these things in the model. These things are being worked on, but that makes for a lot of complications as well. And finally, I'd be remiss if I didn't mention globalization and international policy arrangements as another missing aspect of this model. I've actually worked on this myself with a co-author, Artie Singh, and other co-authors, but that would take us into another whole realm of discussion. But you do have aspects of American policies interacting with European policy and other G7 policymakers, including Japan and including emerging market economies, especially China. So the fact that there's a lot of things aren't in the toy model make you think about something else. Is there some way we could design a policy that would be robust and would work well in a wide variety of models that we probably don't have all of them on the table at this point? And again, for you engineering types in here, there is a so-called robust control literature, so a few of you might know that literature from engineering. You can adopt the engineering ideas, but engineering doesn't have the forward-looking actors that we have in macroeconomics. So you have to adapt what's going on in engineering to the fact that there's forward-looking actors in macroeconomics. That is done. There is a literature on robust control. There are interesting findings, but there's not enough there at this point to really give a clear recommendation of what to do. So let me finish up here and get on to the Q&A. Sometimes I try to talk long enough so we can get rid of the Q&A. But I'll try not to do that here. I think I'm finishing on time. So let me just conclude here. So first, I start off saying that the FOMC set an explicit numerical inflation target. I've argued that such a target is consistent with the Fed's dual mandate. There's a lot of discussion these days about the Fed's dual mandate, but I think that discussion is really about the nature of the Fed's reaction function to economic events. The issue of the Fed's reaction function is separate from the issue of setting an inflation target. So what I tried to show was whether you had a dual mandate or a single mandate, you'd probably behave about the same way in either case. I've also stressed in the last part of the talk that heavy focus on the nature of the Fed's interest rate reaction function in the current environment is kind of questionable. There are many, many issues that aren't in the model that are at least as important, and resolution of any of those issues could change the argument for a particular reaction function. So I'm going to conclude my talk there. It's really fun to come and give this kind of lecture. I'm looking forward to your questions. So thanks a lot.
Thank you. Before we begin the Q&A, let's go ahead and take 2, maybe 3 minutes, let those students who need to go to a next class depart from the auditorium, then we'll begin, and we'll have about 10, 15 minutes for Q&A. That was perfect, just perfect.
Great.
You know, I have to tell you, I wouldn't say this on the screen, but considerably easier to follow for most people than Ed Prescott's conversational.
Are you surprised? Ed's not known as a communicator.
That was great. The way you laid that out, it's exactly what I was really a model for us. And, you know, I hope you don't mind if, you know, can we get your slides? Oh, sure. Because I would like to future use it as a model to our lecturers who come and say, this is the level at which we want to do. Our students who need to go to their 2:30 class to leave. So let's go ahead and open up for questions. And who's got the first question? Yes, go back.
Yeah, I'm reading The Constitution of Liberty by Hayek in one of my classes. A couple of things you mentioned brought something up here. He says that Vladimir Lenin said the best way to destroy the capitalist system was to debauch the currency. And he himself says that governments everywhere and at all times have been the chief cause of the depreciation of the currency, partly by issuing excessive quantities of paper money. Now, it's my understanding that the Federal Reserve has caused over 16 trillion new Federal Reserve notes to be printed over the past few years. Will that massive currency inflation cause price inflation?
First of all, I'm a big fan of Hayek's. He's right that there's been a lot of mischief around the world with governments and inflation over time. And if you look across countries and across time, you'll find that. And, for those of you that don't know, Latin America is a prime example. We just had the case where Argentina has basically eliminated its central bank and taken over its, politicians have taken over the central bank. So there's been two thoughts on this for the major industrialized economies. One is that the central bank should be kept independent and away from the political process, because once you get politicians and governments involved, you're probably going to get a lot of inflation. So that's one aspect, and the ECB was very careful to try to preserve independence of the policymaking process at the ECB. A lot of what's going on in Europe is sort of politicians trying to reach in and pressure the ECB to inflate. So that's one part. I think also this inflation target, it'd be better if you could design a system where somehow it was completely off limits from political forces. But you probably can't do that, and so maybe a second best thing is if you have a central bank, make the central bank tell you what it's going to do, and that means set an explicit inflation target. And if it's not achieving that inflation target, call them into question, fire the people. The original proposal from New Zealand was actually fire the central banker if he doesn't hit the inflation target. I don't know if I'm really an advocate of that. But the notion of getting discipline on the process and avoiding the debacles that have occurred throughout history with way too much inflation and politicians getting their hands on the printing press, that's a very real and important thing. Now, have we printed a lot of base money? We sure have. We've printed a lot of base money. I think the Fed's taking a lot of risk with its very large balance sheet. It could turn into a lot of inflation if we don't play our cards right. So there's good reasons to think we'll be able to take that off the table at the right pace, but we are taking risk. So far, inflation has remained fairly low, fairly close to our target. It's a bit above our target right now. Both CPI and PCE inflation measured from 1 year ago are between 2% and 3%, so it's above our inflation target for right now. So I do think it's a risk. I do worry about it, and I do have hawkish leanings, so I'm trying to get my colleagues to make sure to put enough emphasis on that.
Yes, Dave?
Another thing that's missing from that simple toy model is supply shocks. And the existence of supply shocks, of course, greatly complicates conducting an inflation targeting policy as opposed to, say, a nominal GDP growth policy. How does the Fed handle the problem that's produced by supply shocks, like the supply shocks we've experienced recently with oil price?
Can you all hear the question in the back?
So the question is, how does the Fed respond to oil price shocks or other supply type shocks? Excuse me. This is a difficult issue for central bankers because if oil prices go up a lot, that tends to slow the U.S. economy, but it also tends to increase measures of inflation. So the typical response is to try to judge how much of the increase in oil prices is temporary, and thus can be you can look through it, and how much of the oil price shock is a permanent component. and therefore represents sort of a real shift in supply and demand. Now, when you looked at something like the last 10 years, the price of oil in real terms has about tripled in the last 3 years. Used to be, in today's dollars, used to be around $30 a barrel. Today it's $100 a barrel, West Texas Intermediate or so. So this is really a case, there is a story that can be told that there's a global scramble for resources. And it's led by emerging market economies, which are growing at a very fast pace. And they're competing globally, and this is putting pressure on resources. Now, so you could imagine that energy and other commodity prices will rise faster than the overall CPI for a long period of time. It can't be permanent because otherwise we'd spend all of our income on energy. We're not going to do that. Something else is going to happen before. But it can happen for a long time, and it happens in other sectors. Technology prices declined over time faster, while the CPI has gone up. And medical care has gone up faster over time than the CPI. So you do get this effect where sectors of the economy can go up for a very long, prices can go up for a very long period of time, independently of the overall trend in prices. So I have been worried that we might be in this kind of global scramble for resources kind of scenario where energy prices and commodity prices just continue to rise over time faster than the CPI. If that's the case, then I think you do have to pay attention to the headline measure of inflation, which includes the energy prices in it, because it's just reflecting supply and demand factors around the world. So that's kind of a long answer, but that's some of the considerations on oil price shocks.
Let me come over to this side, yes.
I just had a question. Like, we talked a little bit about how there's been a lot of inflation due to, or there may be a lot of inflation due to the rolling of the printing presses, a lot of currencies being printed. How do you think that's going to affect like international trust in the bond market and the domestic bond market?
No, it's bond markets are monitoring and worrying about this all day, every day. So this is what they do. And but I think the bond vigilantes play a good role because they do offer a market barometer of how much confidence is there in the U.S. central bank, but also other central banks around the world. When they see things they don't like, it registers disapproval right now by changing market prices right at that moment. So in many ways, that's a good process. I think as a policymaker, I like to get market signals. I like to see things happening on a market basis because it's really tells you what people are thinking, where the expectations are. If you look at a country like, Greece recently, but a lot of emerging market countries in the past, and you watch credibility erode, they'll be doing okay for a while. Greece was able to borrow at close to the German rate up until, say, 2009, 2010. So if you look at bond yields in Germany and Greece, they were the same. Greece was just as trustworthy as Germany. That's what the markets were saying, until they weren't. And then, and since then, the prices have gone up. They've gone up, and then just cut out of the market completely. There is no rate at which international markets will lend to the Greek government at this point. They're out of the market.
Professor Simmons.
You have some great titles for some of your talks. One was 3 Funerals and a Wedding.
Yes.
The wedding part of that one, you seemed at least cautiously optimistic of fiscal policy. Are you still that way? Because that was an 08.
Yeah, I gave a speech called Three Funerals and a Wedding, and it basically said that the crisis had killed off 3 cherished beliefs of macroeconomists, and it had revived one belief that I thought was dead. That was the wedding. And the belief that I thought was dead was the belief in the efficacy of fiscal policy. I wrote a new speech just this last year, Death of a Theory. It was about fiscal policy. And it said that we were right all along about fiscal policy, that it actually is not that, does not have high efficacy in a downturn. So if you're interested in that, you might go read the speech, Death of a Theory. You know, I guess a that would be that, you know, can we spend our way to prosperity, you know, given that we have to tax each other in order to do this spending. So suppose we're the whole economy here, and we get in trouble, our economy is not performing very well, and now we say, how can we build things up? Oh, we're gonna go borrow a lot on international markets and tax ourselves later. Well, the taxes that come later are going to affect everybody's behavior in the economy. So there is no such thing as taxing people later. You're sort of taxing, you know, it's just delayed taxes. So it's very questionable why something like that should work. And the intuition that was around macroeconomics up until the crisis was that that wasn't a good way to conduct business cycle stabilization policy. And I think the crisis has shown that that is true.
Let's go back over to this side. I think I saw a hand over here. Yes.
Yeah, you mentioned how like keeping the government and the Fed separate. Thomas Jefferson once said, if the American people ever allow private banks to control the issues of their currency, first by inflation and then by deflation, the banks and the corporations that will grow up around them will deprive the people of all property until their children wake up homeless on the continent that their fathers conquered. Now, right now, I understand that the Fed's buying 50 to 60% of the U.S. Treasuries, their bonds right now, because no one else will, because people don't want our debt. How do you see where, I mean, there's a lot to say, but I'm trying to compress it.
Sure.
How do you see that the Federal Reserve, something that our Constitution and our founding fathers did not want as a central bank, and now with the jobs, people can't find jobs, people's retirements are getting wiped out, the corporations that control our retirements are getting wiped out, and we have to bail them out with TARP funds. What's your opinion on that? Like, where do you see that?
I mean, you know, you can't outmarket me. I am like the North Pole of markets. You know, I want market solutions to all our problems. We have to have monetary arrangements of some kind. We have a Federal Reserve. I think the challenge is to get it to work as best you can. And one big element of that is to keep the Fed independent from the political process. And you could abolish the Fed and say, well, let's just let the Senate Banking Committee decide, or the Joint Economic Committee decide. That's what you could do.
What's the difference?
And you can say, you know, you can have other monetary arrangements, and we have in our history, with mixed success, I would have to say. But I'm very...
Can you say a word about gold? I think there are a lot of people...
Oh, sure. Yeah. No, I mean, the thing about the gold standard, I wouldn't really say I'm against it. We had a gold standard from the time of the collapse of the second bank in the United States up until the founding of the Federal Reserve. And it had a lot of backing, it had a lot of political support. But it also we saw what the equilibrium was. The equilibrium was that there were lots of panics and lots of problems in the U.S. financial sector. And especially, people in the middle of the country, like where I'm from, St. Louis, did not like the fact that they were at the mercy of the New York banks during these panics. That was a key element. But even with all that, I think, and the metallic standards, silver versus gold, was a huge political issue in the late 19th century. William Jennings Bryan, for instance. So the key issue was that the Panic of 1907 came along. The Panic of 1907 was so severe that even the last holdouts for the gold standard threw in the towel. They said something has to be done. We don't know what, but we got to do something. And so they came up with, let's say, an original arrangement, which is the Federal Reserve. And what did they do? They tried to protect the Federal Reserve from the political process by doing a couple things: spreading the banks around the country, which I think was a great thing to do. So there's 12 banks around the country. They gave some of the power of monetary policy to people like me that are not in New York and not in Washington and not politically appointed. So I think that's an important consideration. You've got the Board of Governors in Washington. They provide oversight to the banks, but they don't have they can't call all the shots on monetary policy. And above all, New York cannot call all the shots because they've got all the big banks in New York, just as they did 100 years ago. So they had some elements of a good plan to try to keep this monetary arrangement working. But it was in response to the gold standard, in response to the panic of 1907. So, I mean, you can do things other ways, and I've certainly written about it myself, private currency issuance. Check out my paper with Bruce Smith on that. So there are other ways to do these monetary arrangements. You know, for me as a policymaker, I've got to work with what we've got today.
Maybe as the last question, I could just ask you to reflect a little bit on the significance of the Federal Reserve Act. Was it 1935, whatever it was, 34, that caused Mariner Eccles to be the first chairman of that new institution, just so that we might have some sense of the historical significance of Mariner Eccles.
I'd be happy to talk about that. The original Federal Reserve Act envisioned the different districts having different interest rates. So the St. Louis interest rate would be different from the San Francisco interest rate. And you guys out here, if you wanted to borrow, would face the rates that were dictated in this region of the country. And the notion was that the different regions of the country are different, so they should have different rates. As the economy continued to integrate in the 20s, that became less and less of, and through World War I and into the 20s, that became less and less tenable. So you really want to set an interest rate nationally, so that's one element of it. And other aspects of the original formulation weren't working. So the notion was, let's set up an independent body in the 1930s. Let's set up an independent body that'll have a responsibility for monetary policy, and that was the formulation of today's Federal Open Market Committee. So it was a different arrangement. It's actually a big committee. If the Board of Governors is at full strength, there are 7 governors, plus there's 12 people around, 12 presidents like me around the country, so it's 19 people. It actually takes quite a while just to go around the table and have everybody pitch in a little bit of a conversation. It takes like 90 minutes to do that. So you have to be very careful if you're going to ask what everybody thinks. I do think that on the whole it's been pretty successful because you do get viewpoints from around the country. I think that's quite important in setting monetary policy. You do limit the influence of the inside the Beltway crowd, and believe me, they're you know, that's a different world. It's very much a fishbowl in Washington, D.C. So by getting a representation from around the country, and you do get some limitations on New York City, thinking they run everything and they've got all the power. So I think to break it up the way it is broken up, lots of people involved, and kind of a changing mosaic over time as people come and go on the committee. I think it has been pretty successful over the years. I would have said really successful, except that we had this crisis starting in 2007, so that it's really been shaking the foundations of macroeconomics and monetary economics in the last 5 years because so many things went wrong. But I would still say, generally speaking, over the history of the FOMC, it has worked fairly well.
Dr. Bullard, thank you so much.
All right, thank you.